For years, the scaling of artificial intelligence was treated purely as a software problem. But as models expand from billions to trillions of parameters, that digital expansion has hit a hard, physical ceiling. Data centers have evolved from code repositories into massive industrial furnaces. This collision between software ambition and the strict limits of material reality has triggered the physical AI supply shock. The scaling laws that drive general intelligence are now bound by atoms, not bits. The future of the digital revolution is entirely dictated by the global extraction of heavy metals, moving past the control of software engineers. Institutional capital is already moving to price in this physical shortage. We see this play out on the trading floors of the London Metal Exchange, where digital concepts give way to raw material contracts. The footprint of this shift is visible in the Global X Copper Miners ETF, or COPEX, specifically within the options chain expiring in 2026. COPEX is a fund that tracks a basket of global copper mining companies. This table shows the COPEX option chain, starting with the baseline spot price of $72.29. When we examine the volume metrics, an anomaly emerges. The put-call ratio sits at 0.34. This ratio compares the volume of bearish put options to bullish call options. A number this low indicates a concentration of betting on upward price movement. Next to that, implied volatility, a metric that captures the market's expectation of future price swings, sits at an unusually high 60.05%. High implied volatility paired with a deeply skewed put-call ratio reflects a market pricing in a massive, sustained upward price dislocation rather than hedging against downside risk. Crucially, this intense options volume is concentrated on expiration dates stretching out to 2026 and beyond. This aggressive bullishness in a raw material is occurring right as broader macroeconomic indicators point to cooling inflation and stabilizing interest rates. Retail traders do not buy deep out-of-the-money options 2 years in advance. This pattern marks the footprint of massive institutional accumulation. These traders are locking in long-term exposure because the math is inescapable. Copper has transitioned from a cyclical industrial metal tied to housing and construction into an inelastic necessity for digital infrastructure. To understand why institutions are taking these positions, we have to look inside the physical footprint of modern cloud computing. A traditional cloud server rack manages basic data routing and storage, but a modern AI computing node like NVIDIA's Blackwell architecture, which links 72 graphics processing units together, operates under different physical demands. Training large language models requires these GPUs to communicate instantly across the entire cluster, moving massive terabytes of data in parallel. To handle that throughput, a single 72 GPU node requires 16 times more fiber optic cabling than standard racks. Once connected, these dense computing clusters require massive power distribution networks to pull electricity from the grid to the processors. As a result, hyperscale AI facilities now require up to 50,000 metric tons of copper per gigawatt installation. That is 3 to 4 times the copper density of a conventional data center. A large portion of this heavy metal is dedicated to advanced liquid cooling infrastructure, necessary to prevent the concentrated GPU clusters from melting under their own thermal loads. The rest is consumed by specialized grounding systems and enhanced power arrays required to safely handle the immense voltage. Tech giants cannot software optimize their way out of these requirements. Silicon processors must be powered, and waste heat must be moved. Because AI computations are thermally and electrically hostile, they demand raw physical matter to exist, regardless of software efficiency. Data centers alone would strain the supply chain, but this build-out is happening concurrently with a broader macroeconomic shift toward global electrification. The transportation sector's transition away from fossil fuels relies on high-conductivity metals. Electric motors, battery systems, and charging infrastructure mean that a single electric vehicle requires 4 times the copper of an internal combustion engine. Simultaneously, deploying renewable energy sources like wind and solar requires vast new transmission networks to tie remote generation sites to major population centers. This chart shows copper demand projections through 2030. At the base of the new demand, J.P. Morgan estimates data centers alone will consume 475,000 metric tons by 2026. That specific AI requirement is expanding at a compound annual growth rate of 15.6%, pushing toward 850,000 tons by the end of the decade. A compound annual growth rate, or CAGR, measures the steady, smoothed-out rate of return over a specified time period. Right above that, the transportation sector is accelerating at a nearly identical 15.1% rate, growing from 2.4 million to 4.2 million tons. All of this high-growth consumption stacks directly on top of a massive base layer of 8.5 million tons required simply to maintain and replace the traditional grid. This simultaneous multi-sector scaling creates entirely inelastic demand. The global economy is attempting to transition its energy and computational base at once, with no viable substitute materials available to carry the load. While demand scales exponentially on a spreadsheet, supply is constrained by the linear, geological reality of extraction. The primary geological headwind is ore degradation. Global copper ore grades have fallen below 0.6%. Miners today must extract and process twice as much physical rock as 25 years ago to yield the same output of refined metal. Furthermore, developing a new mining project requires 8 to 15 years to navigate environmental permitting and infrastructure construction. Even when the ore is extracted, it hits a processing bottleneck at mature smelting facilities operating near maximum capacity. The mining industry is structurally incapable of a rapid supply response. The AI-driven demand shock is accelerating directly into an immovable geological ceiling. Modeling this collision of supply and demand has created a divergence among Tier 1 financial institutions. This comparative model shows two interpretations. On the left, JP Morgan projects a 330,000-ton structural deficit of refined copper for 2026 due to unyielding AI demand. Conversely, Goldman Sachs maintains an opposing view, projecting a 160,000-ton market surplus for the same year. Goldman's surplus model relies on the premise that high spot prices will trigger rapid supply additions and cause manufacturers to use less metal. To determine which model is accurate, we have to look past the forecasts and track real-world corporate behavior. Recently, an influx of over 730,000 tons of copper was imported into U.S. warehouses. This metal remains idle on transport lines, rather than being immediately deployed, representing an effective hoarding of the domestic supply chain. At the same time, tech giants are bypassing traditional commodity trading mechanisms. Amazon Web Services recently executed a direct purchasing agreement with Rio Tinto to secure copper straight from the mine. This perceived global supply surplus is a byproduct of strategic corporate stockpiling. Tech giants are aggressively hoarding the raw materials required for their next generation of data centers to front-run the impending physical shortage. The final operational question for institutional allocators is how to capture this upside. Industry models suggest prices must hit $9 per pound to properly incentivize new mine development, yet current prices remain below that threshold. This matrix evaluates mining equities. The vertical axis tracks cash cost positioning and reserve life extension, verifying miners can outlast a supercycle without margin collapse. The horizontal axis measures jurisdictional stability and vertical integration, highlighting firms with owned smelting capacity in politically stable regions. The long-term value of the artificial intelligence revolution will accrue to the capital allocators who successfully secure the raw atoms required to power the code.